Mastering personal finance is the key to living a life free from money worries. It's about taking control of how you earn, spend, save, and invest your money, allowing you to achieve financial freedom. Whether you're hoping to pay off debt, save for the future, or simply manage your finances better, understanding the basics of personal finance is essential. In this video, we will tell you how you can master personal finance and get your financial freedom. So, make sure to watch the video till the end and subscribe to our channel. Also, press the bell icon for more updates. Let's get started. Understanding personal finance. Understanding the basics of personal finance is really important. It's all about how you manage your money, from earning to spending, saving, and investing. It encompasses budgeting, retirement planning, managing debt, tax planning, and making sound investment decisions. The importance of personal finance cannot be overstated. Without a solid financial plan, it's easy to fall into debt, overspend, or be caught unprepared for emergencies. At its core, personal finance revolves around building good habits that help you live within your means, save for the future, and make informed decisions about how you spend and grow your wealth. To master personal finance, you need to develop a mindset that sees money as a tool, not the ultimate goal. Financial freedom is about control. Control over your income, expenses, and long-term plans. So let's break it into steps how you can master it and get your ultimate freedom. Step number 1. Create a realistic budget. One of the most fundamental steps in mastering personal finance is creating a budget that reflects your income, needs, and goals. A budget is like a financial roadmap. It shows you where your money is coming from and where it's going. Many people find budgeting tedious, but it doesn't have to be complex. Start by listing your monthly income and all your essential expenses: housing, utilities, groceries, transportation, and debt payments. Once you have a clear view of your fixed expenses, determine how much you can allocate to discretionary spending. Things like dining out, entertainment, and shopping. The key to sticking to a budget is making sure it's realistic. If you cut all your entertainment or leisure spending, you might find it hard to stick to your plan. Instead, strike a balance between saving and enjoying life within your financial limits. Tracking your expenses is crucial too. Many people are surprised at how small purchases add up over time. By reviewing your spending regularly, you can spot patterns and make adjustments when necessary. Budgeting apps like Mint or YNAB, You Need a Budget, can help you stay on track and monitor your progress. Step number 2. Build an emergency fund. An emergency fund is a financial cushion that can protect you from unexpected expenses like medical bills, car repairs, or losing your job. Without an emergency fund, you might be forced to rely on credit cards or loans, which can lead to debt and financial stress. Ideally, an emergency fund should cover at least 3 to 6 months' worth of living expenses. Start by setting aside a small amount each month, even if it's just $20 or $50. Over time, this will grow into a more significant sum. Keep your emergency fund in a separate, easily accessible account, like a high-yield savings account, where you can earn some interest but still withdraw the money quickly when needed. Remember, this fund is for emergencies, not for vacations or splurges. Step number 3. Pay off debt strategically. Debt is one of the biggest obstacles to financial freedom. Whether it's student loans, credit card debt, or a mortgage, owing money means you're working to pay someone else rather than building your own wealth. To master personal finance, you must have a plan to eliminate debt as quickly and efficiently as possible. Start by listing all your debts, including the amount owed, interest rates, and minimum monthly payments. Then consider 2 main strategies for paying off debt: the debt snowball method and the debt avalanche method. With the snowball method, you focus on paying off your smallest debt first, while making minimum payments on all other debts. Once that smallest debt is paid, you move on to the next smallest. This method is motivating because you see results quickly, but it might not save you the most money in interest. The debt avalanche method, on the other hand, prioritizes paying off the debt with the highest interest rate first, which can save you more money in the long run. Whichever method you choose, the key is consistency. Pay more than the minimum whenever possible and avoid taking on new debt. Step number 4. Save and invest for the future. Once you've paid down your high-interest debt and built a comfortable emergency fund, it's time to start thinking about your future financial goals. Saving for retirement, a home, or a child's education are all significant milestones, and the earlier you start, the better. When it comes to retirement, taking advantage of employer-sponsored retirement plans, such as a 401k, is one of the best ways to grow your wealth. If your employer offers matching contributions, contribute at least enough to get the full match. This is essentially free money that can help grow your savings faster. Beyond employer plans, individual retirement accounts, IRAs, offer tax advantages for long-term saving. Roth IRAs, for example, allow your investments to grow tax-free, which can be a huge benefit in retirement. If you're saving for other goals like a down payment on a house, look into high-interest savings accounts or certificates of deposit, CDs, for safe, steady growth. For those interested in growing their wealth even more, investing in the stock market can be a powerful tool. While investing comes with risks, historically, the stock market has provided higher returns than keeping money in a savings account. You can start by investing in index funds or exchange-traded funds, ETFs, which offer a diversified portfolio with lower risk than individual stocks. Over time, compound interest can significantly grow your investments. Step number 5, keep track of your progress and adjust mastering. Personal finance isn't a one-time effort. It requires ongoing monitoring and adjustments. Life changes, and so do your financial goals. Maybe you get a new job with a higher salary, or perhaps an unexpected expense arises. Whatever the situation, regularly reviewing your budget and financial goals is essential for staying on track. Set aside time each month to review your finances. Look at how much you've saved, how your investments are performing, and whether you're sticking to your budget. Are there areas where you can cut back on spending? Could you increase your retirement contributions? Regular check-ins help you stay accountable and make necessary adjustments before financial problems arise. Additionally, don't hesitate to seek professional help if needed. A financial advisor can provide valuable insight and help tailor a plan that meets your individual goals. Sometimes, having an outside perspective can highlight areas for improvement that you might have overlooked. Step number 6, plan for taxes and maximize deductions. Taxes can take a big chunk out of your income, but with some planning, you can minimize their impact. Understanding the tax deductions and credits available to you can save you hundreds, if not thousands, each year. For instance, contributing to retirement accounts like a 401k or IRA not only helps you save for the future, but also reduces your taxable income. Other common deductions include interest paid on student loans, home mortgage interest, and contributions to health savings accounts, HSAs. If you're self-employed, you may be able to deduct business-related expenses, such as office supplies, travel, or the cost of health insurance. Keeping good records of all your deductions throughout the year will make tax season much less stressful. Consulting with a tax professional can help ensure you're taking advantage of all the tax breaks available to you and avoiding costly mistakes. Step number 7. Stay disciplined and avoid financial temptations. The road to financial freedom requires discipline. It's easy to get tempted by short-term pleasures, like a new gadget or an expensive vacation, but these can derail your long-term goals. Staying focused on your bigger financial objectives, like saving for retirement or paying off your mortgage, requires self-control. One way to stay disciplined is by automating your savings and bill payments. When you automate, you remove the temptation to spend that money elsewhere. Set up automatic transfers to your savings or retirement accounts and schedule bill payments so you never miss a due date. Another strategy is to adopt a pay yourself first mentality. This means prioritizing saving and investing over discretionary spending. Before you splurge on a non-essential item, ask yourself whether it will help you reach your financial goals. That's all for today's video. I hope you liked the video. If you have any questions, you can ask in the comment section below. Subscribe and hit the bell icon for more updates. Thanks for watching.